Okay. All right, I'm ready to go whenever you are. All right, welcome to the show, folks. Jason Bible, Texas Real Estate Radio Network. When I started yesterday the discussion on inflation, I didn't intend for it to take up a full 2 hours. But we're going there. I know all you got. Oops, sorry, I just dropped my phone. I know all you folks are excited to talk another hour about inflation, but I think it's a really important point. I got a ton of reply emails to the email I sent out, whenever that was, Sunday night, Monday morning, about inflation and the impact on real estate. So just to recap from yesterday's show, governments fund their activities two ways. One of two ways, typically both. One is through taxation. Everybody gets that. Income tax, property tax, sales tax, all value-added tax, all that stuff. There's actually talk of a wealth tax in California, which is going to be quite interesting if the rest of the country begins to adopt that methodology. But taxation is one way that governments are funded. The second way is through inflation. And the best way to describe this is for every dollar that's printed that makes it into circulation, every subsequent dollar is worth less. It's worth your dollar in 1950 is not the same dollar in value as it is today. Now, economists will tell you there's virtually no inflation. And I've said from the get-go that inflation shows up in one of four areas. And those four areas are something that most folks in a modern Western economy cannot do without. And what are those four things? Healthcare, higher education, automobiles, and real estate. You have to, in order to be successful in a modern Western economy, you have to participate in commerce of those four things. At some point, you're going to need healthcare. If you want to get a decent job, you've got to have some kind of higher education, college degree, graduate school, that sort of thing. You've got to have an automobile, some kind of transportation. Even if you don't own the automobile and you're just Ubering around, at the end of the day, that cost is embedded in the cost of that Uber ride. And then, of course, real estate. You got to live somewhere. You can only couch surf so long. So where is inflation? It shows up in these four areas: healthcare, higher education, automobiles, and real estate. Those are the four areas you are most likely to encounter inflation. Now, the interesting thing is how does that inflation just show up in those four assets? And it's pretty simple. When dollars are printed, and let's back up, they're not physically printed. Like when someone says, oh yeah, the Federal Reserve just printed off $20 trillion. They don't have like a printer with a whole bunch of ink and the cotton that's used to make bills, make the physical notes. In fact, the vast majority of, quote, bill printing, money printing $100 bills, $20 bills, $5 bills, is the vast majority of that printing is just to replace what's already in circulation. In other words, bills that are just torn up and expired, and they go in and they physically damaged notes is probably a better way to put it. So there's not a real printer out there that prints $20 trillion. Like, it doesn't come in pallets, There's a bunch of ink. It's like a really big printer. It's a really big printer. And then there's paper and an ink, and they put it together and it gets printed. It's not physically printed. Because the reality is they can't physically print that much money. Like, that's the reality. A lot of people they may miss that when they hear things like, oh, well, they're just printing more money. They think they're physically printing it. No, they're not. It's really a electronic funds transfer. It's ones and zeros in your computer. They just add a couple of zeros and send it over. I mean, that's really how it works. So what happens when all of this money hits the system, if you will, the economy? Now, in 2008, 2009 till about early last year, those dollars really stayed within the banking system. I mean, sure, they got out, rates were lowered, that sort of thing, but they really kind of stayed in the system. It did have a detrimental impact on rates. In other words, interest rates came down. In fact, this is one of my arguments when I hear people say, well, Jason, you don't understand, rates at some point are going to come up. And I tell them, explain to me how that's going to work. Because debt is at an all-time low. See, in order for debt to increase in value, in other words, interest rates to rise, there has to be less buyers of debt. That's really how it works. Or there's just less debt. It's a supply and demand conversation. If there's less debt in the marketplace and there are people buying debt as financial instruments, as investments, then the rates will rise because there's just less stuff to buy. However, if you look at worldwide debt from countries, what they call sovereign debt, from corporations, 60% of the worldwide debt trades at 2% interest or less. So what that tells me is debt really has no value or very little value. So the idea that, oh, Jason, interest rates are going to rise, it's going to crush all these economies, I keep asking somebody, well, explain to me how that works. Because if 60% of worldwide debt trades at less than 2% interest, what's the mechanism that's going to put pricing pressure, upward pricing pressure on worldwide debt? And the answer is there just isn't any. Debt is cheap, and it's going to continue to be cheap. So I don't see rates rising in our lifetime. I always get the guys, the old timers. I'm 42. So a little bit before I was born, we had 17, 18, 19% interest rates on single family real estate. And somebody would tell me like, Jason, you understand, back in my day, I bought my first house. It was 18% interest. I'm like, yeah, dude, that was 50 years ago. That's not going to happen again in our lifetime. Until we have really rapid inflation. Now, here's what's interesting about worldwide debt, and let's talk about inflation for a little bit. You'll hear this term, inflate away the debt. What does that mean? It means if I can borrow money today and my dollar is worth less in the future, I can pay the future debt off with less expensive dollars, with cheaper dollars. That's kind of the trick that's happening right now in the United States. If we can we can borrow a few $1 trillion over here and pay it back in the future when that $1 trillion is worth less, it's actually a pretty good deal. This is why I said in that email, be very, very careful with long-term notes. Because what's really happening is someone is borrowing money at a rate today, but we know those dollars they're paying back that debt with are worth less in the future than they are today. There's really no disputing that. You can pull up on any kind of search engine on your phone, Just pull up inflation calculator, and you could see how much less a dollar is worth today than it was even 20 years ago. We get back from the break. We're going to talk more about inflation and how to guard against it. It's Jason Bible, Texas Real Estate Radio Network. I'm ready to go. Welcome back. Jason Bible, Texas Real Estate Radio Network. We're talking about inflation today, inflating away the debt, and how that impacts your portfolio. So the United States printed about $20 trillion in response to the coronavirus. And Rob and I have watched this like a hawk, and I'll tell you why. Because every dollar that gets printed is worth less than the dollar that came before it. This is one of the reasons why you're seeing gold doing the things that it's doing, or the stock market. I talked a little bit about this yesterday. One of the things I love to have a conversation about is when someone says, Jason, you need to get into precious metals and gold to hedge against inflation. And the question I always ask is, well, how much debt of that $2,000 an ounce, or whatever it is, $1,900, honestly, I don't even know what it's at right now. Let's call it $2,000 an ounce. What percentage of that $2,000 an ounce is debt? All of these mining companies use a massive amount of leverage. In other words, debt to go and mine for gold. All across the value chain. From the guys digging it up from the ground, to the folks that are smelting the gold, turning it into bars, to the transportation companies, to the gold brokers, most of them have a significant amount of debt. So the question is, of that $2,000 gold bar or gold ounce, what percentage of that is debt? Everyone talks about a store of value, but I always ask, well, how do you define a store of value? Like for me, it was real simple. I had, this is the most profound lesson I got in business school. Whole bunch of finance people in the room. And we had our finance professor walk up and he said, look, I'm going to give you guys a PhD in finance in about 5 minutes. Everybody's sitting on the edge of their seat. Like, oh, okay. Tell us what the story is. And he said, your job as future business owners, entrepreneurs, CFOs, COOs, or even if you're just head of your household, with just a regular old job, your job is to convert financial assets to real assets. Like there's really only, now I'm going to bug all the accountants in the room, there's really only two assets out there, two types. There's financial assets and real assets. And all financial assets, all of them are just derivatives of real assets. They derive their value from real assets. In fact, let me blow your mind here. If you were to take all the financial assets in the world, let me pull let's see, what do I have in here today? I probably got a couple $100. Here we go. We got a couple $100 right here. If we were to take all of the financial assets that I've got here in my wallet, I don't know, $200 or $300, whatever it is, I were to put this together with all the financial assets in the world, all the currencies, all the debt, all the equities, all the stocks, bonds, mutual, all that stuff. If we were to take all those financial assets and put them in a bucket, what would they be worth? So my professor asked this question. He says, if we were to put all this stuff in a bucket, what would that bucket be worth? And you could see everyone's like, smoke is coming out of their ears because we're trying to calculate, well, I don't know, is it like 50 trillion? Is it like 100 trillion? It's like US GDP is about $25 trillion. I mean, what is the whole, I mean, you're going through this mathematics, right? Like, 45 trillion, 35 trillion. I mean, if you were to take all of the financial assets, even in the derivatives markets, and put it all into one bucket, what would it be worth? And I know you're doing this at home. If you're driving in your car somewhere, you're thinking, what is that number? It's got to be a gigantic number. But here's the reality. If you take all of the financial assets in the entire world and put them all in a bucket, the value is zero. I'm going to say that again. If you take all the financial assets in the world and put them into a bucket, the contents of that bucket would be worth zero. Because all financial assets are claims and counterclaims. It's a dollar given for a dollar owed. You put all the financial assets into one bucket, it's worth zero. In fact, the bucket is worth more than all of the financial assets in the world. Now the question is, why is that? Because the bucket is a real asset. It's got real value, real utility. One of the reasons that we invest in real estate is because if the world were to completely end tomorrow and the dollar is worth nothing, I have a real asset, a place for someone to live. And it doesn't matter if you're going to pay me in, euros or Deutschmarks or dollars or in bananas. At the end of the day, I've got the real asset. And if the whole world's economy ends, I'm going to be paid something to live in that real asset. These dollars, and I've said this before on the radio show, these dollars, I'm holding my money clip up right here for those of you who are not watching the video. But these dollars are great for bar tabs and cars and, having fun and that sort of thing. But they don't really have any value. Where the value is in the businesses and real estate that produce these dollars. Like, that's where the real value is. The real value is in the business. The real value is in the real estate. If the world ends tomorrow and the dollar ends and people are, go back to ancient times and we're paying each other with clamshells, we're not trading dollars, we're trading clamshells. Nobody wants dollars anymore. But I own the real estate, so I'm just going to get paid in whatever the new currency is. That's why I'm not afraid of a collapse in the dollar. One could argue quite succinctly, the dollar's already crashed. Like, when it's lost as much value given a certain period of time, one could already make the argument that the dollar's really not worth that much already. Why is this important to investors? Because if you've got cash, inflation is a war on cash. This couple $100 I got in my money clip here is worth less today than it was yesterday. It's worth less today than it was 2 years ago. So if you've got a pile of cash that you should be investing, and I'm not talking about savings. Yeah, everybody's got to have a little cushion, right, for emergencies. I get that. But your cash that you should be investing has got to get out and do some investing. Because this cash is worth less every single day. And I'll tell you right now, the 20 trillion that got printed during the coronavirus, virtually none of that has hit the marketplace yet. It's going to take years, if not a decade, for them to get that 20 trillion out. There's just only so many mechanisms to get the money out. We get back, we'll talk a little bit more about inflation. It's Jason Bible, Texas Real Estate Radio Network. Hold on one second. All right, I'm ready. Welcome back, Jason Bible, Texas Real Estate Radio Network. We're talking about inflation today. Inflating away the debt. Inflating away the value of your dollars. These dollars are worth less every day. So it's great to be a borrower. Wait a minute. You're going to lend me, I got $100 right here. Let me pull this out of the old. So I got 200 here. I probably got $400 here. So here's this $100 bill. Nice, crispy hundo. $100 bill. So someone will lend me, a bank will lend me this $100 bill that then I can repay in the future when that $100 bill is worth less than it is today. It is great to be a borrower. And I'm not talking about borrowing money for 2 or 3 years. I'm talking about borrowing money for 30. I've got a house I'm buying for $200,000. It needs, let's say, $100,000 in rehab. So I'm all in for $300,000. I could borrow $300,000 and repay it over 30 years with less valuable dollars. And don't get me wrong, I'm going to pay some interest rate on it, 2 3/4, 3%. Let's call it 3%. But here's the crazy thing. If I borrow money for 30 years at 3%, and inflation, at least according to shadow stats, not the government statistics, I'll tell you right now, inflation and the consumer price index, those metrics have changed with just about every single presidential administration. Like they change it every couple of years. I mean, you guys remember when oil was $100 a barrel? They took energy out of the consumer price index, what's called the CPI, and metrics for inflation. They've actually taken housing out, I believe in 99, if I'm not mistaken. So if you don't have some of the most expensive, from a household standpoint, largest share of the household expenditures in your metrics for consumer prices and inflation, then are you really measuring inflation correctly? And I would argue absolutely not. So Shadow Stats, a great website. If you click on inflation, you can see it. They've got the little chart. They have their own metrics that they produce. By their estimates, inflation is running 6%. Meaning this $100 bill here, this shiny, beautiful hundo, this $100 bill is worth 6% less 12 months from now. Meaning this $100 bill 12 months from now is worth $94. So those of y'all in the debt business, and those of you guys who are holding cash, keep that in mind. Every 12 months, it's losing 6% of its value. And by the way, that's compounded. 6%. That's a 0.5% per month. Every month, your cash is sitting in a bank somewhere, not being invested. It's worth 0.5% less. Period. It's no more difficult than that. That's what inflation does. Now, for those of us who are borrowers, I'm borrowing this $100. You can lend me $100 today, and I can pay you $94 in the future, and that will settle my $100 debt. It's great for borrowers. It's not so great for lenders. So at 6%, if I'm borrowing money for a single family house at 3%, the bank is losing 3% per year. Why is that? Well, if inflation is at 6% and they're lending it to me at 3%, 6 minus 3 is 3. At least according to my math. You're losing, when the bank lends to you, the bank is losing 3% per year. That's the delta. If the bank were lending it to me at 6%, they would be breaking even. If the bank were lending it to me at 10%, they're really making about 4% on their money, accounting for inflation. It's a super easy calculation to do. So keep this in mind when you're looking at investments. Let's say you're going to lend some money, you're going to buy some bonds, or you're going to do a long-term. A lot of owner finance guys, they'll go out and buy these properties, they'll owner finance them at 9%. They'll buy a property, fix it up, take a 20% down payment, and then owner finance it. That's a very common methodology. You're really making 3% on your money. That's really what's going on there. Don't get me wrong. There's ways to, you're going to leverage it. You do this. I mean, there's a million ways to slice these things up. But we're just using a very simple example. You're charging 9%. Oh, Jason, I'm getting 9% of my money. Oh, okay. Well, how much is inflation? Well, it's 6%. So you're really making 3%. And don't get me wrong. It's a great return. But just keep in mind, it's really about 3% because of inflation. Why is the Dow at 30,000? In part because of inflation. There are too many dollars chasing too few deals. Look at the price to earnings ratio in a lot of these companies. It makes absolutely no sense. When I graduated from business school in 2008, no, it was 2009. When I graduated from business school in 2009, we used to calculate companies' value. There's a couple of ways to do it, but one of the tried and true methods is something called free cash flow. How much free cash flow is a company producing? Sometimes you'll hear it this way. You get the really nerdy guys on the business channels. They'll say it this. Well, what is a company's surplus? It's a kind of a funny way to put it. What's their surplus? What that really means is how much cash are they producing surplus? In other words, surplus cash are they producing from their operations? Free cash flow. You would then take that cash flow number, add a multiplier, a handful of other things, and it would tell you how much a company is worth. And I can tell you, since the money printing machine got fired up again in 2008 and 2009, those calculations now make no sense. In fact, here, I'll throw one at you that you guys will absolutely love. One of the things that we used to do in finance, which I don't think anyone does anymore, it's too old school, makes too much sense, is they would look at what's called the risk-free rate of return. That's typically some kind of sovereign debt, let's say a 10-year treasury. Well, your risk-free rate of return is less than 2%. In other words, the federal government is highly unlikely to default on its debt, meaning it's risk-free for me to buy a 10-year note. So what's the relative risk if I were to say lend that money on a real estate deal or buy a single-family house? We get back from the break. We'll talk more about inflation and risk-free rates of returns. Jason Bible, Texas Real Estate Radio Network. Knocking them out. Dude, it's seriously like 80 degrees in here.
I know.
It's crazy hot. It feels like a jungle. We've got a jungle there, but it feels like a jungle. All right, I'm ready to go when you are. Welcome back, Texas Real Estate Radio Network's Jason Bible. We're talking about inflation and risk-free rates of return. So back in the day, 10, 12 years ago, we used to calculate rates of return, and we would compare them on a risk basis. Meaning, how risky is it to own Tesla, an apartment complex, and a 10-year treasury? What's the relative risk? Because the treasury is returning 2%, maybe an apartment makes me 20%, and owning Tesla, I mean, who knows? I don't know what the estimated rates of return are. But you would have to come up with some metric to figure out what is the relative risk between all those assets. And that's where things get really interesting. A lot of portfolio management, a lot of the math and modern portfolio theory, especially when it's weighted for risk, assumes that a 10-year treasury actually produces a reasonable rate of return. One of the things that's been kicked around the last 6 or 8 months is negative rates. In other words, the debt is so cheap, it would have a negative interest rate. You're just looking to park the cash somewhere. It's like negative interest. Let me put it this way. There's so much cash in the system, you have to pay to store it. It's negative interest rates at, let's say, a bank. The bank's like, look, we'll take your, $100,000, but our interest rates are -2. What does that tell you? It tells you that cash is almost worthless. Debt is almost worthless. That's really what that means. It's like having to, we're buying a storage facility right now. It's kind of like owning a storage facility where you park your junk, except for your junk is piles of cash. You've got to store it somewhere. It's a fascinating problem. Where does the cash go? That's what negative interest rates are. And they've been kicking this idea around for the last 6 or 8 months. Well, how do all these financial calculators and all the math work when your risk-free rate of return is negative? And I can tell you right now, they don't. All those financial models go right out the window when the risk-free rate of return is negative. Because what does that mean? From a financial standpoint, it means the risk is in holding cash. Well, what happens when this $100 bill, simply holding this $100 bill in cash, is the riskiest part? Meaning, if this $100 bill here, is not out in a deal, then it's worth less every day. And to store it in a 10-year treasury yields a negative return that really tells you that these dollars are worth virtually nothing. We will see, I guarantee you, because a lot of Europe is already there. We will see negative rates at the Fed level, the Treasury level, in our lifetime. Debt keeps getting cheaper and cheaper. There's no place to put the money. We can, to put a finer point on it, we cannot physically print the money. Like the money that's been approved through fiscal and monetary policy, mostly through monetary policy, although some fiscal policy coming out of Congress, the executive branch. I mean, let's not parse words here. Trump is not conservative when it comes to this stuff. I mean, he had no problem printing all that money. No problem at all. In fact, would get on Twitter and brag that we didn't print enough. There wasn't enough money in the system. We physically cannot print the cash. That's how much is in the system. These dollars are worth less every single day. And there is a high likelihood that we will see negative rates before we'll ever see rates approaching 10, 12, 18, 20%. The question is why? Because there's so much cash. It's everywhere. And if that cash is sitting in a checking account or savings account somewhere, it's worth less every day. They're going to start charging you to store your money. I mean, digitally. I mean, it's not like, you go to the bank, you got a couple $100,000 and it's, sitting in a vault with your name on it. They're going to start charging you for your money to sit idle in a bank. That will absolutely happen. So what does that tell you? It tells you this is already worthless. Brian and I have had this conversation, I don't know how many times. And we're pretty much in agreement that if the dollars are not out there moving in a deal, you're losing money. You're losing a lot of money. And it's not just opportunity costs. That idleness of the dollar through inflation is worth less every single day. And if that dollar just sits in that checking account, it's losing value. And with the past 6 months, with 20 trillion out there, it's only going to get worse. So what should you do as a real estate investor? I'll give you a couple of hints. I would be really hesitant to do any long-term deals without equity. And when I mean long-term, I mean greater than 5 years. You're going to need that equity to protect you from inflation. You may get a 9, 10, 12, 15, 20% return on your debt, depending on how you structure it. But it's that equity you're really going to need. Why? Because the 6% inflation number, I think, is going to be low by about a factor of 3 over the next 6 to 7 years. That $20 trillion at some point is going to hit the street. And it's going to show up, like I said, in one of 4 places. Actually, all 4 places. And probably some others too. It's just too much money. It's going to head to a bank near you. And then that bank is going to loan those dollars out. And they're going to loan them out for healthcare expenses, higher education, automobiles, or real estate. That's how the inflation mechanism works. Congress says, everybody needs a bailout. Here's your, whatever it was, $1,000 check a week or whatever it was that they passed with the PPP program. Treasury and Fed do their thing, print another, couple $100 billion, few $1 trillion. That money ends up at a bank. The money for your PPP program ends up at a bank. The banks then distribute through debt to allow consumers to buy those assets. That's one of the reasons why housing right now is on fire, because debt is now 3%. Wait till it dips below 2%. Are we going to see, quote, free mortgages in our lifetime? We certainly could. It's a lot more. It's more likely that you could get a free mortgage just so the bank can make the money on the underwriting side and the creation of the note than the actual rate of return on the note. Nobody's making money on 3% mortgages. I can tell you that right now. So guys, I'm highly encouraging you, get into some deals, put that cash to work, and I will see you guys tomorrow. It's Jason Bible, Texas Real Estate Radio Network. Knocking it out.